Paul, why don't we go ahead and get started? I know there's some others I'm emailing and texting with that are getting on, so we can just go ahead and get started here. First of all, thank you so much, everybody, for joining. I know there might be some guests with us this morning. I really appreciate everybody being here. I know there's some conflicts in the area in terms of timing, which will happen. Mayor Demings, who I appreciate all the work he does, also scheduled his state of the county this morning at the same time. So let's just work through those challenges. And again, thank you everybody for joining. We've got a fantastic speaker this morning, Paul Handerhan with the FAIR Foundation, here to talk about the special session that just occurred in Tallahassee. Has a significant background in the insurance industry, first-party property insurance market for the last 2 decades. Paul founded FAIR, the Federal Association for Insurance Reform, and as its president has grown the organization into a broadly recognized and creditable national insurance trade association. So congratulations on that, Paul. Well done.
Yeah, thank you, Chris.
Yeah, Paul previously served as the president of FIVA, the Florida Association of Public Insurance Adjusters, the largest statewide public insurance adjusting association in the United States, and has significant experience and background in this industry. So we really appreciate Paul joining us and speaking to this significant legislation from the 2022 May special session. So Paul, thank you, and take it away.
Yeah, thanks, Chris, and thanks to the Seminole County Chamber for having me today. It's my pleasure. Today, what I'm going to do is I'm going to go over the legislation that passed during the special session dealing with property insurance. Once I go through it at kind of a high level, we'll pause, and if you guys have any specific questions, I'll do my best to try to address them. So when you're looking at this legislation and the reason why we had a special session on property insurance, if you're following the market at all, you've probably heard, your constituents or your neighbors talk about having a difficult time finding insurance, or if they can find insurance, the rate of insurance going up dramatically to the point where it's really becoming cost prohibitive for a lot of folks. So the governor went ahead and put together a special session to try to address the affordability and the availability of insurance in the state of Florida. When you look at this legislation, I think you really need to bifurcate it into 2 categories. One is, what is the short-term impact for consumers? And then what is the longer-term impact that really tries to address some of the fundamental systemic problems in the insurance market? So we'll start with kind of the short-term reforms, which is the RAP program is what they call it in the legislation, which is Reinsurance to Assist Policyholders is the acronym. And basically what it does, for those of you who don't know, when you're dealing with like your local insurance company, let's say like Security First Insurance that sells you your homeowner's insurance, that's what's referred to as a primary insurance company. All the primary insurance companies domestic to Florida, they purchase what is called reinsurance. And that reinsurance is like insurance for insurance companies. So in the event that you have a major catastrophe like a hurricane, most insurance companies wouldn't have the policyholder surplus in order to pay all those claims obligations. So they have to purchase this reinsurance that in the event one of these catastrophes happen, they get reimbursed from this insurance policy. And then to take it a step further, there's also what's called retro reinsurance, which the reinsurers buy additional cover in the global reinsurance market. So that's the way that insurance is diversified into the global marketplace. The challenges that we were having here in Florida is that over the past 4 or 5 years, the primary insurers and the reinsurers have been losing money in their catastrophic business units. So that means catastrophic risks that could be wildfires, tornadoes, hurricanes, floods, tsunamis, all across the globe. That has been, not a moneymaker for them across the globe over the past 5 years. So what you saw is the reinsurers start to ask themselves, is there better places that we can put this risk capital instead of into this catastrophic business unit area that we have? And that's what's happened. So that reinsurance market has hardened over the past 3 years. And these companies who are required to purchase this reinsurance to keep their rating and also to be compliant with the Office of Insurance Regulation, we're going out to the private reinsurance market And we're starting to see that, wait a second, there may not be enough capacity in the private reinsurance market for us to complete our reinsurance obligations by June 1st. So the governor and the legislature created this program, the RAP program, which provides $2 billion of free reinsurance to Florida domestic companies. And the way that they get to utilize that coverage is that $2 billion. When you think about reinsurance, it's almost like a tower, and at different layers, the lower the layer, that's when, if you have a claim at $1, obviously you pay that first. At $1 million, you got to wait till the claims get to $1 million before you pay that. So the lower down on the reinsurance tower, usually the more expensive the coverage is. So this $2 billion attached right below the Florida Hurricane Catastrophe Fund, which is pretty close down to like where the working layers are, where it's a kind of like higher risk, more expensive rate on line. The hope was that this was going to provide some meaningful rate benefit for consumers, and was also going to help some of the insurance companies that couldn't find private reinsurance capacity in the marketplace, that this would help fill some holes or gaps in the reinsurance program. What we're hearing is that it did provide some benefit to some carriers. And I think, I'm very appreciative to the governor and the legislature. They actually gave this coverage away for free. There was no charge for it, which typically you pay for that in the private market. Unfortunately, the feedback that I'm getting from insurance companies on the rate benefit is the reinsurers, even though that small layer of coverage was offered, they really didn't lower their rates at all because it was such a hard market. There was no need for the reinsurance companies to lower their rate because it was actually a situation where there were still companies that couldn't find the coverage that they needed. So it's basically going to the reinsurer, begging for capacity and then saying, oh, by the way, the legislature created this RAP program. Can you also give me a discount? And basically they turned around and said, no, we're not giving you any discount. You're actually lucky that we're providing you the reinsurance coverage. So if one of the objectives were to provide some meaningful rate benefit for consumers by offering this RAP program, unfortunately, that did not materialize. So you guys understand for your local constituents, what happens is after June 1st, when an insurance company files and completes their reinsurance programs, they file what's called a reinsurance rate filing with the office, basically saying, this is what our reinsurance program cost us, and this is what we're going to put into our rate to recoup that cost. Well, your constituents come September 1st, when they start opening up their bills, will start to see those price increases due to the cost of reinsurance. So unfortunately, it's not going to be a situation where anybody's getting a rate decrease. It's actually the inverse. Come September 1st, there will continue to be rate increases due to reinsurance. We're also being told that kind of this trajectory is not going to change for the next couple of years. So reinsurance is going to continue. That market is going to continue to harden, and the rates are probably going to continue to rise. So there's more rate pain for consumers moving forward on the reinsurance side. On the capacity side, I think a lot of carriers did take advantage of the $2 billion. The problem with the coverage that was provided, it was only for hurricane risk. And typically below the CAT fund, when you buy your reinsurance, it's not only for hurricane risk, but it's for all weather risk. So that would mean like a localized convective storm, tornadoes, hailstorms. So again, a reason why they didn't get a price break is they were still buying reinsurance in that same layer anyways. It was just for the non-CAT weather events. So they still had to go purchase reinsurance regardless that they got that free hurricane coverage. I think what a better public policy forum would have been, instead of giving $2 billion away for free, they should have given $6 billion in capacity, made it all weather, so that it would cover hurricanes, non-hurricane weather events, and instead of giving it away for free, charge for it. I didn't hear any insurance companies asking for free reinsurance. They just wanted to have the capacity so they could complete their programs, and that would have had a much more meaningful rate benefit for consumers. That being said, June 1st has passed. There's nothing the legislature can do about it now. We've already had one insurance company get their rating withdrawn last Friday, which was Southern Fidelity. They have about 70,000 policies, and they're going to be going out of business because they couldn't complete the reinsurance program. So that's 70,000 policyholders who are going to have to find coverage somewhere else, either in the private market or with Citizens or for forced place coverage, which is not a good thing for consumers to try to be, grappling with in the middle of hurricane season. We're also hearing that potentially there's, up to maybe a half a dozen other companies that have not been able to complete their reinsurance programs and that may be following a similar trajectory as Southern Fidelity. We'll probably know more on that within the next 10 days or so, where those numbers start to come and being released. So I can follow up with Chris and with Julie, and then she can update the membership in the event that we do have other insurance companies that lose their ratings and wind up either going into receivership or to some type of organized runoff. So if you look at the short term, if I had to grade the legislature and the governor, I would probably have to give them a C- because there was no rate benefit. And we still in jeopardy of losing a bunch of companies. And there was more meaningful things that they could have done on the reinsurance side to stabilize this market and mitigate those issues. That being said, there's still an opportunity for the legislature and the governor because we have another session coming up, right? Committee weeks will start in January. There's talk about potentially a special session in November. Reinsurance is going to have to be a focal point of the legislature next year because this situation is only going to get worse and Florida consumers really can't afford to lose more private market insurance companies just because there's no private market reinsurance capacity available for the marketplace. So I know that's kind of complicated. The other sections we'll go through a little bit more quickly and they should be a little bit easier to understand. But if you're interested in reinsurance, when we get to the questions part, I can drill down a little bit more.
Sounds good. Thank you.
Now we'll transition to more of like the longer term systemic problems with the marketplace. And this is where I think the legislature and the governor really scored relatively well. I'd probably give them a B+, A- in this area. One of the things that they did, which I thought was very consumer centric, is they brought back the My Florida Safe Home program. For those of you that don't know, this program used to be in existence after the 2004-2005 hurricane season. And it was basically like a mitigation program that gave grant dollars to homeowners if they agreed to do certain wind hardening projects to their structures. So the previous program was dollar for dollar matching. If you went and you replaced your roof, you pay $1 out of pocket, the grant would match that dollar up to a certain amount. This program is actually a little bit better this time because it's for every dollar that you spend, they'll match it with $2, up to $10,000. The only thing is, and for Seminole County, I don't know if you have any areas that are in the kind of like the high wind zone areas, but the program is limited to those areas. So, there may be areas in your area that don't comply or don't qualify for the program, but you may have friends or families in other coastal areas that you'll want to share this information with. The cap is $10,000. So the example would be, let's say I qualify and I want to go ahead and I want to put a new shingle roof on my house, and the total cost of the shingle roof is $15,000. If I go ahead and I put down $5,000, the state will match $10,000 of the $15,000 to replace that roof. So a very good deal for consumers. Obviously, that has a positive impact on the insurance industry because it reduces the risk from non-cat weather events and catastrophic weather events. I would tell you, there's a set amount of money. So they allocated $150 million for this program. Some of that goes to inspections. About 125 million is for the actual renovation projects. I'm sure they're going to go through that money pretty quickly. If you do have residents that qualify for this program, what I would be telling them to do is, because the bill doesn't go into effect until July, I imagine the program won't be operational maybe till August or September. But I would be going out right now, finding a contractor to do a certain wind hardening project, whether it's replacing windows and doors or replacing your roof, and try to get those numbers and that agreement in place now, because as soon as the program opens, you're going to want to be able to submit that paperwork right away. Because if you wait till the program opens, then try to find a contractor, then try to negotiate a bid, by the time you get all that done, the money might be gone. So I would be proactive. Go ahead, get all your paperwork in order. You don't have to pay the contractor. You can say this contract goes into effect July 1st or whenever the program starts, but have all those pieces in place. So as soon as that program opens, you can go ahead and file your paperwork. Because I'm sure, even though they haven't fully designed the program yet, I'm sure one of the criteria for the grant is going to be they're going to want to see an executed contract for the scope of work that you're completing and what the price is, right? So that's going to be mandatory. So I would get that, and that's what could take potentially the longest time to put together. So I would go ahead and do that now. Another area in the bill talked about contractor solicitations. So there was a bill 2 years ago, which was called Senate Bill 76. You've probably all heard about, roofers hyper soliciting, going around knocking on doors, telling people that they can get them free roofs. Well, in that previous bill, there was a ban on the solicitation. The roofers couldn't go around and promise people free roofs. That was challenged in the courts. A roofing association group said that was an infringement upon their commercial free speech. That case was given an injunction and then was tracking through the appellate courts. Instead of going through the judicial process, the legislature just redrafted the language and said, okay, you can solicit in this new bill in the special session, but you have to provide a disclosure to these homeowners. And that disclosure includes notice to the homeowner, basically telling them you can't rebate the deductible for the homeowner. So what some of the roofers were doing is they're saying, listen, we're going to get you a free roof. It's not going to cost you anything. Well, that's not really true because homeowners had a deductible. And what they were doing is they just weren't collecting the deductible, which is a third-degree felony. So now you have to disclose to the homeowner that they're required to pay for the deductible. And if they don't pay for the deductible, that it's a third-degree felony. And then there was also an area that said you have to disclose to the homeowner that filing a fraudulent claim or filing a misleading claim or filing a claim that's missing information is potentially a third-degree felony. And I think what they were trying to do with this disclosure is just give consumers a second to pause before they decide to sign one of these contracts. Because sometimes if the contractor comes and they sell this so easily, like, you don't have to do anything, it's not going to cost you anything, we're going to work on your behalf to get you a free roof, there's no risk. Now at least there's this disclosure where it says, wait, this might be a little bit more serious. Let me talk to my agent, let me talk to my family members or my friends, get some advice before I just sign this contract. So I think it was just put there to kind of give them a pause, let them think a little bit before they just enter into a contract impulsively. There was another one that talked about roof deductibles. So this was over the regular session, there was some legislation, and this was, I think, trying to deter those same roofing contractors by saying a homeowner can choose to have a separate deductible just for their roof. So if you have a roof claim, you have roof damage, you could have this higher deductible, which is supposed to de-incentivize somebody from filing a roof claim if it's not legitimate, right? So if the contractor comes up and let's say that the roof is just really suffering from maintenance issue or wear and tear, but there's this larger 2% deductible, might be $4,000 or $5,000, it may not be that attractive for them to file a claim on that property. The other benefit to the consumer is if you agree to accept a higher out-of-pocket roof deductible, you would get a premium discount. Now, the concern from the consumer lens is sometimes consumers are very price sensitive and they're just like, give me the policy that's the cheapest. And I don't think I'm ever really going to have a claim anyways. And then they choose these higher deductibles or less coverage. And then the claim comes and they put themselves in a position where they don't have the financial resources in order to do the repairs. So it's really incumbent upon the agent to really explain to the policyholder, if they're choosing these reduction in coverages or these higher deductibles, what the impact is going to be at the time of claim, because it can really adversely impact, policyholders and constituents. Now, the legislature did put into this section some consumer protections. So that roof deductible doesn't apply to hurricanes, okay? the claim has to be adjusted on a replacement cost. So they can't, adjust your loss on actual cash value, which means a depreciated value, and then take the higher roof deductible. If a tree falls on your property or your roof was a total loss, then those hurricane or those roof deductibles, higher roof deductibles don't apply. So they put in some parameters there. It basically is only going to comply, or I'm sorry, it's only going to apply to the type of weather events that are like non-cat weather events. So that would be like a hailstorm, a tornado, convective localized thunderstorm or straight line windstorm, those type of events it could apply to. The next section talked about insurer underwriting. So this was the big problem where a lot of homeowners were getting non-renewals and they were saying your roof is more than 10 years old, so we're no longer going to write your roof. We're going to cancel your policy or non-renew your policy. Or if you were going to look for new coverage, you couldn't find coverage because your roof was 10 years old or older. This law says insurance companies can no longer solely look at the age of the roof to make an underwriting decision on whether to non-renew or to provide you a quote for coverage. And then if your roof is more than 15 years old, they could non-renew you, or they could make a determination that they were not going to provide you coverage. But the homeowner has the opportunity at that point to ask the insurance company to send somebody out to inspect their roof. And then that person, if they say, hey, listen, this roof has at least 5 more years of useful life, then the insurance company would have to renew the coverage, or they would have to extend an offer of coverage to the policyholder. So again, kind of very consumer-centric policy. It was pretty contentious. Insurance companies are saying you're forcing us to write business that we normally wouldn't write. You're going to put us in a greater tenuous financial position, which is going to risk our solvency. There was arguments on the other side that says, listen, we force insurance companies to write all different types of coverage. This is appropriate. I think the real net effect is, though, if you look at a property, there's a number of reasons why insurance companies choose to either non-renew or to extend coverage. The roof age is just one of those criteria, and the bill says that you have to make that determination solely on the roof. So if I have a roof and let's say it's 15 years old, or no, let's say it's 14 years old, but I also have a 12-year-old water heater, right? I can still non-renew you because I say changes the conditions in the policy because of the water heater is older, and I just don't say it's solely based upon the roof age. So I don't know how this gets enforced. It seems like the insurers, if they really want to non-renew the policy or not provide coverage, there's other ways of them doing it without solely saying it was based upon the roof age. So we'll have to see how that plays out, but clearly that was an attempt by the legislature to slow down the non-renewals and the cancellations that policyholders are seeing across the state. There was another section that talked about insurer claims handlings. What was unique about this provision, almost every provision in the bill went into effect as soon as the governor signed it. And this section, which talked about insurer claims handling, doesn't go into effect until January of 2023. And this really probably had the most positive benefit for consumers on claims handling. So I don't know why they delayed the effective date of it. I imagine either there was needed some ramp up time, or there was some advocacy from direct insurer participations. But what the legislation actually did is, and you guys probably aren't aware of this, but back in the day when you used to have insurance adjusters, State Farm would come out to your property and they'd have a checkbook in their hand, right? And they'd come out and they'd adjust your loss and they'd write you a check on the spot. And these guys, I mean, if you were an adjuster, it was pretty much like an esteemed position, right? You had a lot of experience, you got paid well. It was a really good career. Over time, what's happened for scale is insurance companies have moved a lot of that decision-making into the actual insurance company, where now the adjusters that they send out have a lot less discretion, and they're more of like taking photos, they're just taking measurements, maybe they write an estimate, but they send it back to the insurance company. And then somebody at the insurance company makes the final decision on what can get paid. And that person can take the original report written by the adjuster and they can amend it. Now they could amend it up or they could amend it down. I think what people are alluding to in the industry is many times that field adjuster may be writing an estimate and the insurance company's inside claims examiner is dramatically reducing the scope or the indemnity of the payment, but the homeowner is none the wiser. They don't know that this change has happened. So in the future, this legislation will allow a policyholder to reach out to the insurance company and say, I want a copy of all the reports that were written having to do with the estimation of my claim. And it also has a section that says, if the insurance company reduces the indemnity based upon an earlier report, they have to give some reasonable explanation to the policyholder on why they reduced the coverage or the indemnity payment based upon an earlier report. So in the practical sense, how it's going to work is policyholder, isn't going to know that this law is in effect, isn't going to know that, this practice is in place, but they'll probably get a letter that says, hey, listen, we had a previous estimate, but we've changed our determination, and this is why we changed our determination, and there's going to be some letter. That would be the signal for a policyholder to say, I now want to request those previous reports, and I want to see what the differeces were so I can do my own analysis. And obviously, representatives of policyholders can have the policyholders request all those previous reports, and then at least you can see what the differences are and see if they're legitimate or not. There was another section that required those reports to be given to the policyholder upon request within 7 days. So you got to turn it around fairly quickly as well. Again, but those changes don't take effect till January 2023. If you look at some of the other stakeholders that were addressed, there was a lot of emphasis put on attorneys and the practice of how they litigate claims. The next section kind of dealt with that a little bit, and it's a process called the civil remedies notice. Without getting too technical, a policyholder or policyholder's attorney can file what's called a civil remedies notice, which basically gives the insurance company 60 days to cure some type of deficiency. And if they don't cure whatever the issue is within 60 days, and then the homeowner winds up bringing a lawsuit, they prevail on that lawsuit, they can then bring a secondary bad faith action because the insurance company didn't cure the deficiency within that initial 60 days. There was a case called Camarada versus State Farm that went to the Supreme Court. And there was this argument over whether if there's a dispute, but the insurance company evokes appraisal, and there was a civil remedies notice that was filed before but expired, but the appraisal award came out in the favor of the policyholder, but the insurance company pays the appraisal award, is that in and of itself bad faith? Okay, and is that something that would be in violation of the civil remedy notice process? Was it a breach of contract is what they're calling it. State Farm says it's not a breach of contract because they're like, in our contract, we have this alternative dispute resolution, which is appraisal. And that's what it's there for. So when we have a dispute, we go to appraisal. If we are wrong, we pay the appraisal award. We didn't breach our contract. It's part of our contract. So this new language now says, in order to bring a bad faith action, you have to show a breach of contract. This has now just muddied the waters because what they were trying to do is say that if you pay the appraisal award, that you're not going to be on the hook for a bad faith suit. But typically you have to prevail in the underlying civil action before you can bring a bad faith lawsuit. Now I'm hearing some of the plaintiff attorneys saying, all we have to do is establish that there was a breach of contract because of this new law, and we can now bring the underlying civil cause of action and the bad faith lawsuit at the same time. So what does this all mean? This just means this is going to be a lot of lawyering up. This is going to be a lot of questions that the courts are going to have to answer. And this is probably something that the legislature, based upon however the courts rule one way or another, is probably going to address in the future. So there's not a lot of certainty on that point. The next section talked about assignment of benefits. So assignment of benefits is a contract. It's a legal instrument that's been around for 100 years. In and of itself, assignment of benefits, there's nothing really bad or evil about them, but they can be used in a manner that's abusive. And we've seen that kind of in the renovation space and the roofing space, where there's some hyper litigation utilizing assignment of benefits, and it's not always properly disclosed to homeowners what they're signing and what rights they're giving up. But what it basically does, if I'm the policyholder, I can assign Chris my claim, and now Chris, who owns my claim, as if he's a roofer, could bring a lawsuit against my insurance company and say, pay for my roof. And if Chris prevails, or the insurance company says, we don't want to litigate this anymore because it's unclear, Chris is entitled to his attorney's fees and costs. This new legislation says, no, that fee shifting statute was always intended for policyholders, not for third-party companies or organizations. So Chris can still get an assignment of benefits, and Chris can still file a lawsuit, but Chris is going to be liable for his own attorney's fees and costs, which means, you can bring the litigation, but if you prevail or if you settle, each side is going to pay their own fees and costs. Now, that removes a lot of leverage from Chris, and there's probably not a lot of attorneys that are going to want to take Chris's cases anymore. And Chris is probably not going to want to pay $10,000 retainers to these attorneys to file the lawsuits. So you probably see the assignment of benefits, the frequency dramatically be reduced. Now, there's a large state organization that has filed a lawsuit against this provision of the bill, and actually the entire bill, arguing the single subject rule, which I don't think is going to rule out favorably for them. But they're making an equal protection clause argument, saying that you can't say that prevailing party attorney's fees are good for one group but not for us. I don't think that they're going to prevail on that argument either. But they should hope that they don't prevail, because I think if they prevail, I think you could see the legislature go and have another special session and just ban assignments completely, right? So I think, the legislature was trying to preserve the right to have an assignment, but get at the litigation. But being that those same contractors are now contested the bill and the legislation, if they were to prevail or get a temporary injunction, I think they would get even more draconian legislative reforms that would completely put that industry out of business. So again, another area where there's a lot of uncertainty. We don't know where it's going to land, but that's tracking through the courts right now. There was another section which talked about attorney's fees again, and this has to do with attorney fee multipliers. So the way that it works, if you're a consumer and you file a lawsuit and you prevail, you're entitled to your fees and costs, like we just talked about. An attorney, how they get their fees and costs, it's what's called a lodestar. All the lodestar is, it's basically your hourly rate times the hours that you worked on the case. And you multiply those two together, and then that's your lodestar fee. That's what you're entitled to. However, if the case was such a case where a policyholder would have difficulty finding competent representation, or the case was extremely complicated, at the judge's discretion, they could award what's called a fee multiplier. So they could say, okay, your lodestar was $100,000, but we're going to give you a 1.5 times fee multiplier. So they would times that 100,000 times 1.5 to increase the attorney's fees because of the complexity or the lack of ability to get representation in that specific case. Now, there's been fighting about when that's appropriate, whether it's appropriate. They're really given out pretty rarely, but there's certain local judicial jurisdictions that give them out more liberally than others, right? And sometimes the severity of those fees can be pretty high. The U.S. Supreme Court had come out with a ruling that said, listen, contingency fee awards in federal cases can only be given out in rare and exceptional situations, right? So that's the federal standard. So what the state has now done is they've adopted the federal standard. So you can only get a contingency fee in rare and exceptional situations. So the case has to be rare, and there has to be an exceptional situation with the case. That kind of raises the threshold or the bar on the ability to get a contingency fee multiplier. And a lot, I think what was going on with the fee multiplier is there was some additional leverage on behalf of the plaintiff's attorney to say, hey, settle my case now and give me, what I want in indemnity and attorney's fees. Because if I prevail later on, I'm going to be asking for a contingency fee multiplier, and this judge regularly gives them out. So it was used as leverage. So I think that leverage has been lessened a little bit. And I think that the frequency of getting them is going to be reduced in the future. There was some plaintiff attorneys that thought this was the worst thing on the planet. There were other plaintiff attorneys that said, listen, if this is what we have to give up to improve the marketplace, we're okay with it. We don't think it's that big of a deal. I haven't heard about any challenges to that. So that's probably going to be the law of the land moving forward. In the bill that passed 2 years ago, there was this provision that said, before you file a lawsuit, you have to give notice to the insurance company. You have to tell them what the demand is, and you have to give them a certain amount of days for them to respond, where they say, yes, we want to pay. No, we don't want to pay. We want to go to mediation. We want to go to appraisal. We want to go to some other alternative dispute resolution format. But it wouldn't be a situation where an insurance company showed up on Monday morning and they got served with 10 lawsuits that they didn't know were coming, right? So now you have to give them notice. There was some argument, that law went into effect last July, on which policies had to comply with that law. And there was an argument saying that it was only new and renewal policies after June 1st, not claims after July 1st. And it was not retroactive to policies that were in effect before July 1st, right? So some attorneys were complying, some weren't. This now says if a judge dismisses your case because they said that you should have complied with the pre-suit notice and you didn't, the plaintiff attorney or the representative is now going to have to pay the attorney's fees and costs of the insurance company to defend that action of not filing the pre-suit notice. So that was put in place to encourage plaintiff attorneys from going ahead and utilizing the pre-suit notice and not taking that risk moving forward. I imagine that is a pretty big risk. You could transfer those costs to the policyholder, but then I think the policyholder would probably sue the attorney for professional liability because they didn't follow the law and they filed a lawsuit. So I imagine it's enough incentive to encourage the plaintiff attorneys to start complying with the pre-suit notice. Although July 1st of 2022, almost every policy would have renewed already anyways, and they would have had to comply. So there's only a small window that this is really helping them comply before the 2022 effective date of all new policies anyways. So that's going to be the law of the land. There was also a thing with assignment of benefits that they changed in this next section, which talked about, let's say Chris is a contractor. He does roofs and he's got 500 assignment of benefits that he signed up. And he says, each one of them is worth $10,000, whatever the number is. A law firm could come to Chris and say, hey, Chris, instead of you waiting 2 years and litigating all these cases, how about you sell me all of those assignments and I'll pay you 50 cents on the dollar of the value of what you think it is. Chris is like, great, I got immediate cash flow. I don't need to litigate the cases. The law firm purchases the assignments and then they litigate them, in perpetuity. They don't really care about the indemnity so much. I mean, they care about the indemnity, but they're getting also the attorney's fees on top of it. So it's kind of a windfall for them and what they spent. And you start to see kind of this cottage industry of selling assignments on the secondary market. They've now said only a homeowner can assign their benefits. A third party cannot reassign an original assignment to another third party, which basically ended that practice. So Chris, I'm sorry, you can't resell your assignments anymore.
I think that I think, Paul, you were looking down when I did this, but I think that's a great thing the legislature did. That's a good one.
Yes. So another section now talks about this new unit that's being created, which is called the Insurer Stability Unit. And basically it's being housed under the Office of Insurance Regulation. And its job is to really look at insurance companies and make sure that they're practicing their businesses appropriately and that their solvency is not at risk. And it's there to look at the reinsurance market and any kind of like drivers or factors that could adversely impact the insurance company, whether it's things that are, outside of their control or things that they're doing from a management standpoint, that they're not managing their businesses properly. There's this new unit that's overseeing these insurance companies. Now, the Office of Insurance Regulation really had that purview already, and they already had all this authority. The only difference is the office has, thousands of things that they have to oversee and regulate on an everyday basis, right? Lots of lines of insurance, lots of things that they need to look at. This new unit, when they wake up for breakfast every morning, this is all they're going to do. They're going to look at these property insurance companies and make sure that if there's any warning signs about their solvency, that they kind of catch it quickly and identify it. The other thing that they're going to do is they're going to report to the legislature twice a year, January 1st, and I believe June 1st. They're going to do a presentation to the legislature, the majority party and the minority party of both chambers, and say, these are our findings of these insurance companies, and this is what the marketplace looks like. I think that's going to be good because you're going to have this third-party report now that's kind of lays the land of the marketplace. So you have a better sense of what's going on before you get to catastrophic failure, where everybody's scrambling to stop the dike from completely collapsing and flooding the city. You're basically doing maintenance and review of these insurance companies way in advance. And if they're their own management practices, you address it. If it's third-party bad actors abusing the system, you address it. But it'll be identified early on. So that's probably going to be a good thing. If you read the bill, the scope of their powers is extremely broad. There are lots of things that they can look at, lots of powers. They can call for market conduct exams where they go in and examine the books of all these insurance companies, which then have to be paid for by the insurance companies. And that was the last section of Senate Bill 2D. So TD, if you guys are wondering why that D is there, that D stands for Delta. So we've already had special sessions. So we've had, Alpha, Beta, Charlie, and we're now at Delta, right? So we may have an echo in the future if we have another special session. There was another bill that was passed. It was called 4D or 4 Delta. That addressed some building and law and ordinance coverage. What that is, so you guys know, your local building department, let's just say, and this one impacted roofs. We'll just talk about roofs as the example. So let's say, it's not an insurance claim, right? But your roof gets damaged for whatever reason, and you go and you try to repair your roof. But the repair you want to do to your roof is more than 25%. The local Florida building department or building code and the local building department says, you can't repair your roof when it's more than when you're doing a repair of more than 25% within 1 year. If you're doing that scope of repairs, they want you to replace the entire roof. Now, why is that? Obviously, there's life safety issues. If they feel if the roof is damaged by more than 25%, it really shouldn't be repaired. It should be replaced at that point. Makes sense. That was implemented, I think, after Andrew to make sure that we have the highest standards. It was also, as the roofing standards increase, you really don't want a roof that's being repaired over 40 or 50 years, right? You want the roofs at some point to be to the latest building code. So by incentivizing replacement of these roofs when repairs are more than 25% over 1 year, kind of improves the roofing stock across the state, kind of like what we're doing with that My Safe Florida Home program, which benefits insurance, benefits life safety. But there was the reason why they changed this, and let me tell you what the change is first, and then I'll tell you why I think they changed it. So basically what they did is they changed that rule, and they said now, if you can repair the roof, you can repair it up to any amount. You want to do a 50% repair, want to do a 75% repair, you can repair the roof if you want to repair it. From a consumer standpoint or a public policy standpoint, I don't really think it's a great public policy. You're basically allowing for these roofs to be compromised, in the event, even if it can be repaired and you're amenable to a repair, next time you have a storm or something, you now have a compromised roof structure, you're putting people at risk, you're potentially putting those roofs in a position where, they're going to be more susceptible to leaks now. So now you're going to have potential air quality issues and mold inside the house, more life safety issues. And the argument was why we should do this is because the roofers are going around saying, this is one of their tools that they use to say, we can get you a free roof because we only have to establish 25% of repairs, and the insurance company has to pay us for the whole roof. Okay, I get it. And I'm sure that was being abused, but you've now just traded the life safety for consumers to address this insurance issue and this economic issue on insurance policies. I'm not sure that was the greatest trade. And then there's also other areas that you're still going to have to replace the roof as an insurance company anyways, right? Because a lot of these manufacturers don't manufacture the same tiles, whether it's the color or the scope. They change the size, the scope, or the profile of these tiles. So when you go to repair them anyways, they're unrepairable because the building materials don't interlock anymore, or they're not the same color. And you have a matching statute in Florida that says the uniformity of the roof has to match anyways. So in effect, you're still going to have to pay for these claims. And you just removed all this life safety away from consumers. So if I had to give the worst grade of all the bills, I'd probably give this one an F because I don't think it's going to be effective at all. And I think you actually put consumers in harm. But the attempt was to de-incentivize or lower the frequency and severity of these roofing claims that were being hyper solicited by roofers. The last kind of day and a half of the session, they added some language to this bill, which was dealing with condos, which was really dealing with the Surfside collapse in Miami. That's not really my area of expertise, but I'll give you a very high level. They required these condominiums to do structural inspections of these condominiums on a regular basis to make sure that there's any structural issues that they're identified. It also required, there's a big issue with condos on whether they're reserving properly to be able to do the maintenance and the repairs on an ongoing basis on their property. So, if you think about it, if I live in a smaller condominium association and the vast majority of all my residences are in their 70s, 80s, or 90s, do they really want to go through a huge assessment to do a structural repair? Or in their mind, are they saying, listen, I'm on Social Security, a fixed budget. I may not be around that much longer. Let's just kick the can down the road, and this will be someone else's problem. Well, unfortunately, that is happening with a great amount of frequency, which has created now this situation where you have all these condo associations who have no reserves to do their maintenance. And even though that they know that these structures are getting to the point where there's life safety issues, there's no funds to actually do it, and they don't have the money, they can't get a loan. So this is now requiring them to take steps that they have to start doing reserve studies on what type of reserves that they need and start putting funds aside for those maintenance repairs. Now, I'm very empathetic that is going to be extreme pain point for some consumers that are low income that are not going to have the funds to do that. And there's probably not a great answer. I guess local municipalities could talk about doing some kind of grant programs. The state could do it. But, from what I heard, probably these people are on their own. So if you can't afford to live in that condo and you can't afford to pay the reserves, chances are you're going to probably have to sell your condo. And you're going to have to find another place to live. I mean, that's just the unfortunate reality of where I think we're going in the future. But again, I haven't drilled down into that bill, so I could be off on some of those subjects. There might be people that know a little bit better than mine, but that's my high level understanding. So take it for what I'm giving it to you as. My comments may not be 100% appropriate, or there may be certain intricacies that I'm not aware of. So with that kind of concludes my bill analysis. And if you guys have any specific questions, I'll do my best to try to address them. Thank you, Chris.
Thank you, Paul. That was fantastic. Maribel, I believe that's you in chat asking those questions. Hopefully you got all of yours answered there. I think Paul probably addressed them in his closing discussion there. Were there any other questions from the group? Yeah, John, please. You're on mute.
Yeah. Good morning, Paul.
Morning.
And good morning, Chris. Thanks, guys.
Yeah.
I'm actually new for the issues and committees over here in Seminole County, but I do a lot with the chamber. Paul, thanks for being here this morning. I know you do a ton of work and you're kind of valuable. Some of the information you shared today, I was aware of, but some of the stuff kind of prompted some questions. The program that they rolled out for like high velocity wind zones, that is that going to be, say if you've done, I know it's coming up, the program, right? But if you've done anything retroactively in the last 6 months, would you be able to file once the commencement date is?
No, so the bill won't be effective to July 1st. And it may be that it has to be restoration after the program is actually created, which we don't know what the actual date. They're still in the process of developing the program. So we'll get that information to Chris and to Julie. They can share it with the Seminole County and all the members. But my guess would be it's not going to be retroactive. So if you have a previous renovation project, you're not going to be able to submit that for grant dollars. It'll be something proactively moving forward.
Wonderful. I have a couple others that nobody else has, if that's all right. The interest, I don't know.
John, please go ahead.
Awesome, cool. I mean, obviously, this is a public insurance adjuster, so a lot of this.
And just so you guys know, I have plenty of time today. So if we want to spend, I mean, if you guys have time and you got questions, I'm happy to entertain them. So don't feel, I know we're coming up on 10 o'clock, but I have time.
Yeah. When it comes to like the whole roof deductibles and the law, like, the 25% rule and essentially them trying to do away with it or doing away with it, I just kind of, was it ever mentioned, basically the law and ordinance is only, the carriers only owe for those instances when they charge the additional premium for law and ordinance. In some instances, the policyholder might have been with the carrier 5 or 10 years during that roof aging throughout, and then you have the storm come through and over 25% is damaged or needs to be repaired. And that's, the way law and ordinance works. I'm just curious, I would imagine that's come up in passing, or was there ever any?
I mean, listen, there's a benefit to the insurance company because you're right, they're getting a premium for law and ordinance,
Right.
but it basically applies to the law and ordinance of the Florida Building Code. So if the code is now changed and says you can repair the roof versus replace it, which would result in a lower indemnity payment, that means that the insurance company got the same premium or a premium based upon their law and ordinance experience, and then didn't have to make an indemnity payment that it was as high. Now, that being said, insurance companies' rates are based upon their historical experience. And if their cost of law and ordinance goes down, like the indemnity payments associated with that law and ordinance, eventually the rate for law and ordinance will go down too, but there's a lag time since it's based on their historical experience. So there'll be some economic benefit that will inure to the insurance company, but I don't think that was the goal. Like they weren't trying to, say, hey, they're getting some undue premium and not having to pay coverage. It was really trying to address the roofing contractors that were utilizing that statute to incentivize their solicitation of the roofs. That's what they were going after. But you're right, there is some variance there that will inure to the benefit of the insurance company over a short period of time until the actual loss experience catches up with the new, actuarially indicated rate.
Yeah, there's been so many changes.
John, if you don't mind if I jump in. Paul, I have a quick question. What kind of timing do you think we'll see for these changes to really impact the marketplace?
So that's a great point, and I probably should have alluded to that earlier because we broke it down into short-term and long-term. So these long-term benefits that address the claims process, they always take time. So they always provide some immediate benefit, but it's usually on a very small scope because they're not retroactive, right? So it starts to change behavior, but for it to really be meaningful and fully kind of like baked into the operating environment, it usually takes about 12 to 18 months because then you've gone through one full 12-month cycle of all the policies. So you don't have the argument that it's not retroactive to policies that were already in effect before the effective date of the bill. And then, people have really kind of changed their behavior and their business models by that point. I mean, there's even people out there right now that are in violation of the current special session bill, and not because they're doing it intentionally, because they don't know that the bill passed. They don't know how it works, so they're just ignorant of what the new rules and laws are, and they're operating as business as usual. And they only know until maybe they get a letter from the Department of Business Professional Regulations or Department of Financial Services that says, hey, here's your warning, do this again, we're going to hit you with a fine or a more severe violation. So it just takes time to change the behavior, and it takes time to filter through that retroactivity. So I would say 12 to 18 months, you'll start to see the benefits. Now, the good news is that pre-suit notice that will definitely decrease the frequency of lawsuits. That went into effect July 1st of 2021. So we're coming up on that 12-month anniversary, right? So, you're going to start really seeing the benefits of that, in the upcoming 30 days.
Hey, Paul,
Great.
I have a
Thank
question for you. Are you there?
Yes.
Question for you. So now that the Restoration Association has filed a suit with the courts, is this going to affect the legislation as it did with Senate Bill 76? Are you seeing that? I'm just curious how that's going to affect the bill moving forward and
So
the other provisions.
So what they've asked for is an emergency temporary injunction. And what an emergency temporary injunction is, if the judge decides to grant it, it will basically say, none of the state agencies can enforce that area of the legislation. Now, they've asked for the whole bill to be stricken because they said it violates the single subject rule, although the title says general insurance. So I think that they clearly fail on that argument. They maybe have a better argument on the equal protection clause. I don't think they're going to prevail there either. But let's say the judge says, hey, we agree with you on the equal protection clause, and you should be entitled to the fee shifting statute, just like policyholders. That temporary injunction would say, that they're entitled to those fees until the courts, fully address this. And then it would go to, some appellate court that would make the decision. It could go to the Supreme Court. It could be years before you get a final determination. But what I think the Restoration Association is hoping, if we get this temporary injunction, it means we can continue to operate our businesses for the next 4 or 5 years as we litigate this through the court system all the way up to the Supreme Court, which means that they can continue to get those attorney's fees. In practice, I don't think their strategy is that sound, because I think if they prevail on the temporary injunction, the legislature is likely just to come back and then ban the practice of assignments altogether, which is going to put them in an even worse position. And then I think if you're looking through the lens of the insurance industry, that would probably be the best outcome for them, because there's other states that have already banned the practice of assignments. So there's Texas, Louisiana, and some others.
I got another one to throw here in the mix. When it comes to the new laws about the carriers, and they're going to have to provide, the initial independent, adjuster's report, or whoever third-party representatives are. I guess there's 2 parts. Is it only going to be the estimate, or can you ask for all their documentation, like the photo reports and things like that?
So it says any reports associated with the estimate, and it also says any reports from the adjuster. So it doesn't make a distinction on whether that's the inside adjuster or the field adjuster. So I think, that's probably going to be litigated too, because what's going to happen is, the policyholder is going to say, I want a copy of all the reports, and they're going to probably send you the estimates, right? And then a plaintiff attorney is going to get involved, and they're going to well, I want the analysis report from the initial adjuster. I want his notes, everything that he wrote to you and his analysis on how he came up to that estimate. And then I want the reports and analysis of the actual desk adjuster and what they wrote to their supervisor on, whatever that correspondence was. And they're probably going to say, no, I'm not giving it to you. But the way that I read the plain language of the statute, they have to give you all of it, right? The field adjuster, the inside adjuster, all reports associated to the estimate are going to have to be disclosed and given to the policyholder. But I think there's going to be significant pushback on behalf of the insurers of giving all that information. And if it winds up being deemed that, that they have to disclose that, you're going to see probably insurers be very careful on what they're putting in any type of written notes or communications. So even when you get to the point where you can get it, it may not be that meaningful.
Yeah, I
Well-
agree 100%. And I think that's a wonderful new piece of legislation, just because obviously I'm a consumer, policyholder advocate, and all I do is advocate for policyholders. But that's one of my biggest issues on any denial, reopen, supplemental request claims is the lack of them willing to share. You send in what appears to be related to a loss supporting the supplement, and they just say, hey, you haven't sent us anything to change our decision. And a lot of times I'll say, well, can you send me your photos and what you guys looked at? Let me compare it myself. And they just won't do that. So I think that piece of legislation will be wonderful for policyholders, just consumers in general, and their advocates. So very, very good job on that. Thank you for getting that piece. Now that goes into effect January 2023. Would you, if you're still on a supplemental request from 2022, would you be able to retroactively request, an older data loss?
So it says that you can request it as of January 2023. They'll probably make the same argument that the plaintiff bar makes, that it's probably
Yeah.
new and renewal policies after January 23. So,
Yeah.
again, the courts will have to look at it and they'll have to decide that, a lot of this bill is going to be litigated, right? So it's going to be years before, we finally get, concrete, definitive action on, how this is going to play out.
Gotcha. Well, thank you so much, Paul. Really appreciate all the great information this morning. Thank you to Julie for bringing you in, and the Gunster Law Firm for providing such fantastic help whenever we need it, and fantastic speakers like yourself.
Yeah, thank you, Chris, and thank you to the Seminole County Chamber, and obviously thank you to Julie. She's kind of a rock star up in Tallahassee with her lobbying firm, and I
Yes.
very frequently rely on them for resources and information. They just do an excellent job.
You're here.
All right,
I did
guys.
just want, thank you, Paul. You can drop if you'd like. No worries.
Thank you,
All
Paul.
right.
It's been a pleasure.
Bye, guys. Have a great weekend.
Bye.
Thank you.
You too. Thanks.
I did just want to make a mention. Rebecca is not here. Dina, thank you for filling in. Rebecca asked me to mention, hey, don't forget to register for Hobnob next month, July 28th. I'm already registered. Yeah. Also, if you have any connections, I know obviously with this group, we tend to have a few more connections to elected officials. So if you have any connections, please feel free to reach out. If you don't see their names on the list of already attending, please invite them to attend Hobnob and reach out to Rebecca if they want to do so. And finally, this is my last meeting as chair of this committee. Starting next month, Kyle Alexander of the Orlando Regional Realtors Association will take over. She is the Vice President of Public Policy and has served as the vice chair of this committee. And while I know she is at the aforementioned Orange County Mayor's State of the County, she's looking forward to taking on this role and will do a fantastic job for this committee. Did anybody else have anything they wanted to talk about, mention before we get going? All right. Well, thank you very much. And I hope you all have a great rest of your day and a wonderful weekend.
Thank you, Chris. Thanks, guys.
Anytime.
Have a great weekend.